Today we're going to talk about how to read your cash flow statement. Your cash flow statement is the last of the three main financials that you'll want to get familiar with as a business owner. Large companies with many investments and financing activities have much more complicated cash flow statements. But for small business owners, it's actually usually pretty simple. It displays where your cash went between a given set of dates. It shows you how much money was used for operations, investing, and financing activities, and then adds the beginning cash balance plus the change in cash to equal your ending cash balance. It's a great way to see an overview of where your money is being spent. It's easy to look at your bank balance every morning, but that doesn't show how money moves in and out of your bank account. And it doesn't allow you to see a projection of what your bank account balance will be in the next month or two, based on operations requirements and debt obligations. Your cash received minus your cash paid out is equal to your cash flow. And this is the key to maintaining a healthy bank account so that you don't run out of cash. Negative cash flow is often referred to as the burn rate. It's a common term in startups that take on venture capital, with revenue generation being months, if not years away. So the burn rate is the amount of cash that you're burning every month. It's important to remember that net income or net profits from the business that you see on your profit and loss statement don't necessarily equal cash flow. Think about accounts receivable. That income shows up on the profit and loss statement, but no cash was received. Accounts payable. Amounts that you owe vendors work in the opposite way. Expenses will show up on your profit and loss statement, but that cash might not have left your bank account yet. And the same is true for inventory purchases. Although you're putting out the cash beforehand, your inventory doesn't show up as a cost of goods sold item until it's actually sold. So let's start at the top of the cash flow statement with operating activities. This is a summary of your income and expenses for the period. Then you need to account for any adjustments to your operating activities, like cash adjustments for accounts receivable or accounts payable. And then you get your net cash provided by, or used by, if you spent more money than you earned, the operating activities. The next section is investing activities. If you sold any of your business assets, purchased any new fixed assets, or invested in the business or in another company in any other type of way, you'd see the reflection of the cash movement here. And the last of the three sections is financing activities. So any pay down of debt that you've made in the period will be shown here. And you'll also see equity transactions like distributions to the owner show up in this section. Remember that paying the principal on debt is not a business expense that will show up on your P&L, but it is cash out of your bank account. So it's accounted for here under the financing activities. So you add up those three sections, and then add that net to the beginning cash balance, and what you should be left with is your ending cash balance. Hopefully that matches what your balance sheet says, because that's the ultimate goal. Assuming you're turning a profit, how much of that income is paying down debt? How much of that is getting put right into your pocket as the owner? Are you saving any of it and allowing your cash balance to increase consistently every month? Seeing the cash movement shown in summary format, like in the cash flow, can reveal some interesting trends about spending. And now you know how a cash flow statement works. Make sure you check out the video where I run through a few cash flow statements and explain a bit more about them, what's on them, and what I see when looking at them.